What's up, family? This is your brother in the kingdom, Emmanuel Destiny. And of course, welcome to yet another valuable episode under the Forex Beginner series. Today, we're talking about what is, or rather, types of orders, or what are types of orders in trading, right? Many of you know the buy and sell, but what are other orders that may be useful to you as a trader to either protect you from losing much or rather from entering a trade in the safest way? So this is your video, guys. Anyway, if you don't know any of this, or rather you know it, I might say something new that you've never learned, kindly do subscribe, guys, like and switch on that notification button so that every video that we post you may be the first. And of course, do comment down below on what are types of orders that you also use or frequently use. And of course, what I'm sharing is orders that I normally use on a daily basis. So let's just go straight into the information, but let's just play the intro first, then we get in straight into the information. Okay, family, so we have types of Forex orders, okay? And of course, an order is an offer that is sent using your broker's trading platform to open or close a transaction if the instructions are specified by you as satisfied. So basically, the term order refers to when you enter or exit the trade. It has nothing to do you ordering a currency, no. Okay, so types of orders, right, that we have, there are different types, and I'm going to be going through each and every one of them. So there are types of orders that all brokers provide, and some sound weird. Okay, orders will fall into two baskets. We have market orders and then we have pending orders. So a market order is an order that is instantly executed against a price that is provided by your broker. And a pending order is an order that's executed later at the price you specified. So for example, I have them there. So we have market orders, which is now, you press buy now, it opens a buy, you press sell now, it opens a sell. Pending orders, we have buy limits, buy stops, sell stops, sell limits and sell stops. So we're going to be going through each of them right now. So we're going to start with a market order. What are market orders, and the best way to actually explain to a total beginner as you're watching right now? So a market order is an order to buy or sell at the best available price. If you watch the previous episode, you know exactly what I'm talking about, right? When we're talking about spread, price, fluctuations or exchange rates, you must buy at the available price because you want to buy low and sell high. For example, the bid price of Euro USD, let's say it's currently at 1.2140. And the asking price is at 1.2142. I'm just going to say it like that, even though that's not the right way to say it because we're talking about decimal numbers, right? Then if you wanted to buy the USD at the market or at the current market price, then you would have sold at that price of 1.2142. And of course, again, if you decide to click buy, and of course, on your trading platform, it will instantly execute at the price that will be the ask price, right? We buy because of the ask price, we sell at the bid, okay? So please keep in mind that, of course, depending on the current market conditions, there may be a difference between the price that you selected and the final price that will be executed or filled on your trading platform. Again, if you are a bit confused what I said, the previous episode, if you jump there, explains exactly what I was talking about. So now we want to talk about the other type of order, which are limit orders. Okay, so a limit order is an order placed to either buy below the market or to sell below or a certain market price. So there is an order when to buy and when to sell once the price reaches the limited or the limit price, hence the word suggests there. So you place a buy limit order to buy at or below a specified price. And of course, you will also place a sell limit order to sell at a specified price or a better price. So once the market reaches the limit order, the order is now triggered and executed at the limit price or the price you specified. So in the image there, you can see we have the blue dot right here that shows the current price, right? And of course, you can just imagine yourself, you place the buy limit at this price. Once the price moves, it will automatically open that. Provided it goes in your direction, you will be in profits. Okay. And again, and of course, that's a sell limit now. The very same thing. So we can just conclude that the market is here and you've placed your sell limit here. Provided that the market reaches that point and goes in your direction, you'll actually make a profit. Now, the vice versa of that if it crosses, it will still reach your limits, open them, and you'll be in a loss. So it's important that when you use these orders, also use what we call a stop loss order. We'll be talking about them right now. So again, it's very much important that as you trade, it's either you can choose to sit on your monitor the whole day like this, or to place these limits to help you make trading a bit easier for you in terms of, managing your trades. Okay, so that's what I'm saying in this whole thing. Just jump the whole thing just to make it very simple, right? So now we want to talk about what we call a stop entry order. Okay, then we'll talk about stop losses and other stuff right now. So we have what we call stop entry orders. Now, don't confuse it with stop loss. Okay, so a stop order or stops is an order from executing until the price reaches a stop price. Okay, so for example, you would use a stop order when you want to buy only after the price reaches to the stop price, or sell after, or only after the price falls to the stop price. So a stop entry order is an order placed to buy above the market or to sell below the market at a certain price. So you place a stop or a buy stop order. So just as you can see here, I'm going to jump everything just to explain it very easily. So a buy stop, you'll be placing it. So let's just conclude that the market is here. You place your buy stop right here, right? According to your own, analysis or whatsoever that you believe that price needs to continue up. And of course, you cannot really wait and sit on your monitor the whole day. So what you do, you put a buy stop, and provided that the market actually reaches that, it will automatically open it for you and continue. Again, it may open it and reverse once it has maybe gone into 3 or 5 clips after it is triggered and still going to a loss. But another benefit of this is that if the market does not get to the price or the buy stop, or turns around before it even reaches that, it will not open your order. The very same thing applies. Let's just conclude that the market is here and you place it here for whatever reason that you suspect that price will get to the point, provided of course it will trigger that and continue in your direction. So that's what we call sell stop and buy stop. Okay, I just hope you understand. Now we want to talk about stop loss orders. Now we're talking about stop loss orders, and of course, as the name suggests, it's an order to close out if the market price reaches a specified price, which you may represent a loss or a profit. So a stop loss order is a type of order linked to a trade for the purpose of preventing additional losses if the price goes against you. Okay, so it protects you. So if you're in a long position, remember guys, the other episodes, I'm not going to apologize or go ahead. So if you're in a long position, that means if there is a sell stop order, or rather you will put what we call a sell stop order, or if you're in a short position, you'll put what we call a buy stop order, or we can just simply call it stop loss. Remember this type of order, guys, a stop loss order remains in effect until the position is liquidated or you cancel or close the position. Okay, for example, if you went long or buy, right? So that's what it means. Those of you who jumped other episodes, and you went on Euro USD at 1.2230, right? To limit your maximum loss, you will set a stop loss at 1.220. So you're basically putting a stop loss of about 30 pips there to say you're going to allow yourself to lose 30 pips only. So if the market drops all the way unanticipated, guys, it will stop you out and protect you from losing your whole capital. So people who lose their whole capital, it's either you're lazy or you're just gambling. Okay, so trading without a stop loss is simply gambling. So stop losses are extremely helpful, as I've just said right now, because instead of sitting the whole day on your monitor like that, it will just help you to just be able to just put it and be busy with your own business. Okay, so now we want to talk about another thing, a very important thing that I advise you guys to use each and every time. We call this a trailing stop. So a trailing stop is a stop loss order which is attached to a position which automatically moves once profit becomes equal to a higher than the level specified. So a trailing stop is a type of stop loss order. So it's still in stop loss, but now this is a type of stop loss order attached to the trade that moves as price fluctuates. Okay, so let's say you've decided to short on USD JPY at 90.80 with a trailing stop of 20 pips. So that means that your trailing stop will be at 90.60. This means that this means that originally your stop loss is at, let's say, 91.00. And if price goes down and it hits 90.60, your trailing stop will move to down all the way to 98 or break even. Remember though that your stop will stay at the new, or it will stay at the new price level or widen if the market is against you. As well as going back to the example of a trailing stop of 20 pips. If the USD JPY hits 90.40, then your stop would have moved to 90.60. So it always moves 20 pips, and of course you can always modify it as well as anyhow you do. So for example, when I'm always trading Nasdaq, right? I'm a Nasdaq trader for some of you guys who don't know. So because it's so volatile, because of course the pip count is so crazy, I may lose a lot of money while making a lot of money. So immediately when the market goes into profit on my side, I'll take my stop loss and put it into the specified that is above the entry level. So it must be above or below if you're selling above your entry level, right? To protect the profit that you've already made. So whether into 20 pips, and some of the ones that we get on our MetaTrader platform, they can keep on trailing as the price fluctuates. As the price moves, it will keep on moving with it. And if the market turns around, it will kick you out with whatever you've made. So it acts as a stop loss, but this one doesn't just allow the market to go all the way to just cut you out into a loss, but it just cuts you out with profit. I hope it does make sense with what I'm explaining, guys. Of course, that's the end of this episode, guys, but I would advise each and every one of you to use a trailing stop as you're trading, because it's very heartbreaking as a trader to be in profits and then you're busy. After 3 minutes the market was news and it just kicks you out and hits you with a stop loss. So using a trail stop, it puts you at relief, right? To say, okay, I'm in a trade, even if it goes sour, I know it's either I'm gonna break even or just close with small profits. That's what it actually means. Anyway, guys, if you enjoyed this episode, if you enjoyed and learned so much from this information, please kindly subscribe, like, and share, of course, this video so that the algorithm, guys, can get more people coming in to gain more knowledge that you have also gained right now. Anyway, that's it, guys. Catch you on the next episode. This is your brother in the kingdom signing out.